Hello everyone and welcome to this video on revaluation of fixed assets. This is a question that comes from the 2019 Leaving Cert exam. What we know about revaluation of fixed assets is that it's either a question 2, 3 or 4, which means that as opposed to doing your question 1 that carries 120 marks, you do a revaluation of fixed assets, which is 60 markers, and then you do another question that's another 60 marks. So the best thing to do is just have a read through your question. So take a couple of minutes to read through it, and then that will show you exactly what you need to do for the revaluation table. So reading through this one, we see that on the 1st of January 2008, Kilmartin Limited purchased new properties for 800,000 or 480,000, consisting of land 80,000 and buildings 400,000. So the company depreciates buildings at a rate of 2%. So we're familiar with that figure. And again, straight line method. So these are always straight line method. Land is not depreciated, so that's why they've given it to us kind of separated up here. And it said it is company policy to charge a full year's depreciation in the year of acquisition and no depreciation in the year of disposal. So what we can see and what's always the case is that every transaction that we do will happen on the first of some year. So we're not going to charge depreciation for a full year, or we're not going to charge any depreciation if we're getting rid of it on the first day of the year. As well as that, if we bought a new building at the very beginning of the year, you'd expect to have a full year's depreciation on it. So this is just kind of making sure that you're not just assuming, but it's actually a given that that's what you have to do. So that's its policy. So reading through it and always thinking in mind what's a revaluation table going to look like. So we're going to have opening for 2014. So how much depreciation did we have up until 2014? So the very end of 2013. Then we revalue. So we'll have buildings and land. Okay, there'll be two of our columns. Then we'll be revaluing the first year. The second year, we're buying a new building. So this is nearly always the case where we have an extension and a building. And we always have to remember that we always include the value of the contractors. So we're going to add the 50,000 to 130,000. The company's own employees also worked on the extension. So that's also going to be included. So we're basically adding 75,000 onto 130,000. So 2016, we sold land. Perfect. And now we also have to look at this repair. So this is kind of a small aspect that kind of separates, let's say, the H1 students from the rest of the students. Then we revalue buildings again, a 20% increase in respect to each building. And in 2018, we sold buildings. So we sold the buildings that we extended in 2015. So we only had them for 3 years. The remaining buildings were then revalued. So it's kind of a standard enough question, and you'll see that with revaluation. In this case, what the big trick actually was that they gave you when we bought the buildings. Now, a lot of the time what they'll do is they'll tell you what your buildings are, and they'll just say that you've had the buildings for 10 years or something like that. But in this case, we actually see that we bought the buildings at the very beginning of 28. So you have 2008, 9, 10, 11, 12, and 13. So that's 6 years depreciation up until we reach the very beginning of 2014. Okay, so just looking at our table now. So generally, we'll always have buildings, land, some sort of extension or a new building. We always want to do our total, and our total is very important for when we do or land and buildings account, so our T account, and depreciation is also for our T account. Yeah. So what was the opening for 2014? Well, we said that our buildings are 40,000 or 400,000, land was 80,000, and our depreciation was 2% for 6 years. And we don't depreciate land. So 400,000, 80,000. We didn't buy the extension until 2015, so we can put 0 in for 2014 as well. So 0 here. Our total then is 480,000. Now our depreciation is only on buildings, and our buildings is 400k. At 2% would mean that yearly depreciation is 8,000. Again, we said that we had the buildings for 6 years. So we multiply it by 6 and we get 48,000. So these are the opening balance for our T accounts. So what happened in 2014? We revalued property to 620. Of this revaluation, 120 was attributed to the land, so 120,000. So this will increase up to 120,000. So we're not putting the how much we increase by into our boxes. What we put in is how much the value of it is now. Okay, so it increases by 40,000, but we don't put in the increase. We only put in what it's worth now. So 620. So if the total 620 and the land is 120,000, that would mean that the buildings is 500,000. So our depreciation for this year is going to be 2% of 500,000. Which is 10,000. Perfect. And that's all we really need to do for our table. So the tables are quite straightforward. So we purchased a building for 130,000, okay, during 2015. 50,000 was paid to a building contractor for an extension. So we add that on. The company's own employees also worked in the extension to this building and were paid wages amounting to 25,000. So essentially what I'd like to say is that, let's say we purchased this building for 130,000, but it might be really shabby and we mightn't get any value in the building, or there's not much value in the building at all. But if we do some work to it, let's say via extensions, or we just make it more tidy or cleaner, then what we're doing is we're increasing the value of those buildings. So this 50,000 worth of the extension, so obviously extending the building, that's going to increase its value. So it's going to increase by 50,000. Okay. Then the other amount is 25,000. So these are all kind of red herrings, or like they're separating the really good students, because some people would question, oh, why would I add 25,000 because they're only based on wages? But what we're talking about is the value of the building. So we've done 25,000 worth of added value to the building. So what we're going to do is we're going to be adding that 25,000. So it's 50 plus 25,000 plus 130,000. So it's 205,000. The extension of this is. And then there's no change to land. And there's no change to our original buildings. But now the value of everything is 825,000. So be careful of depreciation. We're going to get 2%, but we're going to get 2% of just the buildings. So we're going to get 2% of either 205 plus 500, or you could say 825 minus 120. The same thing. So we'll say, so at the end of the day, it's going to be 2% of 705,000. And what that now gives me is 14,100. Perfect. So we are now talking about selling. So sold, that always makes us think of a disposal account. So that's what selling things like fixed assets should be going into our head. It always means disposal. So we sold for 170,000 land which cost 80. So that just means that they're telling us that it's the original land that we bought. But has since been revalued on the 1st of 1st, 2014. So again, they told us that it was revalued to 120,000. In 2016, Kilmartin Limited spent 10,000 in respective repairs to these buildings. So what this is, we're not actually increasing the value of the land. So the land's value remains at what it was. So it was 120,000. But what's going to happen is we spent repairs. So let's say it dropped in value to 110, and then we had to add back another 110 to make it 120. So nothing goes into land and buildings, okay? But we need to put it into a repairs account. So we're going to have to create a repairs account. So essentially money is leaving our bank account and going into a repairs account. But we add no value to the land and buildings account. And it doesn't affect our disposal. So with that, we go back to our table. So they are all things we need to be careful of when we're actually doing the T accounts. So we're left with 705,000 again. So our depreciation for the year is going to be the exact same because our buildings element hasn't changed, just our land. And we'll just make a note. So sometimes it's worth making note about repairs or making a note about anything that we come across, 10,000. So that's just making me know, okay, I need to do a repairs account. As well as that, we have a disposal for 2016. So they're all the things that we need to be careful of when we're doing this 2016, this year. So in 2017, we revalued buildings owned at 846. So we're revaluing all the buildings we have to 846. And it's a 20% increase of everything. So 846 here. And 205,000 at 20% is 246. So that would make this 600. And if you got an extra 20% of 500,000, it's 100. So that would make sense. Again, we have no land. So our depreciation now, our 2%, is based on 846,000. So it's 16,900. Sorry, 16,920. Now, last one in 2018. So let's try and get through this nice and quick. So now what we're saying is we sold for 225,000 the buildings that were purchased during the extension in 2015. The remaining buildings were revalued to 715. So there's two things going on. We have a revaluation to 715,000. So I'll make another note. We have a revaluation. The second thing is we have a disposal. Okay. So our total value is 715,000. So 715,000 at 2% is 14,300. So our revaluation table is now complete. and we just have to fill in our T accounts with the data that we have. So to do that, we're just going to check our T accounts. So these are the T accounts, and there's kind of a few ways that we can be looking at this. We can either learn them off because there'll always be a land and buildings account. There'll always be a depreciation of buildings account. There'll always be a revaluation reserve account. We'll always have disposal accounts. So we can either make just one big disposal account for land and buildings, or we can segregate them into land and segregate it into buildings. And then we'll also have a revenue reserve. So remember, at the revenue reserve, we can only realize our profits from a revaluation once we've sold the asset. So that's why we use that. So the other account that I'm missing is a repairs account. So I might just, we'll leave that until we reach year 2016. So the first thing to do is to put in our figure for building and to put in our figure for land into our land and buildings account. So again, we use our total like we have up here. And then we put our 48,000 into our T accounts for depreciation as an opening balance. So 2014. So we have on the debit side, the first, I might just zoom in a bit to this specific T account. So we have the first of the first 2014, its opening balance, and it's 480,000. Now we'll go to depreciation account. So it reduces the value of our asset, so it's on the opposite side. So it's on the credit side. Opening balance of, what did we have? 48,000. Okay, so it reduces the value of our land and buildings. So it's the opposite of the land and buildings. So it's obviously going to be a debit. Or sorry, it's obviously going to be a credit because it's reducing the value. So that is this done, basically. Okay, we can say tick. Now we need to do what happened in 2014. So we had a revaluation, I can see, 100,000 in buildings, 400,000 in land. So we're still on 2014. So we've revalued it to 620. So that means I'm going to have to add 140,000 here. And this is going to be going to a revaluation account. So revaluation reserve, 140,000. So that will bring this to 620, which is what we wanted here. So that happened on, again, the 1st of the 1st, 2014. So 140,000. Double entries over here, coming from land and buildings on the 1st of 1st, 2014. Perfect. Now, whenever we revalue, we always want to be talking about our net book value. So that's really important. What we're really interested in is the net book value. So that is essentially cost minus depreciation. So what are the buildings actually worth to us? Well, they were 620,000. Sorry, They were 480 minus 48,000. So everything was 480 minus 48,000. So 432,000. So they're basically only worth 432,000, but we are revaluing them to 620,000. So it's not just enough to just add our 140,000, because if we add 140,000, that's not going to bring us to our 620 based on what it's actually worth. So we also have to include our 48,000 into a revaluation, and that will make up everything we need to make the 620. So we can think of it in net book value, or we can simply just think of it in terms of, if you want to the process, we always need to empty our depreciation of buildings account or our depreciation of fixed asset account whenever we are revaluing something. So we're going to have to empty this. So on the 1st of 1st, 2014, it's going to a revaluation reserve. And we're emptying it. So 48,000 is coming out. So 48,000 coming from depreciation. So what I said was that, or what we need to remember is that our revaluation reserve account and our revenue reserve account, we generally don't balance these until the very end of the question, because there's no real need to do it, because they don't change that often. So we do, however, need to balance this, but we can't do that yet because we haven't added in the depreciation for the very end of the year. So what happens at the very end of the year? Well, I'm going to have to charge depreciation on the buildings. So on the 31st of the 12th, 2014, which account does it go to? It goes to our P&L account as an expense, and it is 10,000. Perfect. Now we can balance it. So it's 58,000. 58,000. We need to balance it, so that means we need to do 10,000 as our balance. What are we doing it? We're calling it down. So it's our balance called down. And our balance brought down is 10,000 too. So the first of the first 15. Whereas this is the 31st of the 12th 14. We also need to balance our land and buildings account. This will be nice and straightforward. Well, we said they were valued at 620,000. So at the very end of the year, the balance, and we're calling it down, is 620,000. So 620,000 is going to be our balance brought down here. So a lot of this is very monotonous, but it just has to be done in order to get full marks. Perfect. So now we can tick 2014. So we dealt with our buildings, our land, so our revaluation, and we dealt with our depreciation charge for the full year. That goes to P&L. So in 2015, we didn't sell anything, but we did buy and renovate, we did buy and do an extension for building 3. So we put in these figures individually, So even though we can see that the total was 205,000, we're going to break it down into 130, 50, and 25. So remember, whenever filling in T accounts, we're always worried about where is it coming from or where is it going to. So in this case, 130,000 has left my bank account to increase the value of my buildings. Okay, 130,000. As well as that, the wages of the contractors would be coming straight from my bank account as well. However, the wages for my all employees will be coming from my wages account. So that's 25,000. So we have to have them separated like that to make sure we get full marks. So the purchase of the buildings is coming from a bank. If we're hiring contractors, it's external, so it's coming from our bank account. However, it's going to be coming from our wages account when we're using our own employees to I guess, help out with the extension. So moving over to depreciation. So we don't have to do anything else because there's no revalue going on, but we do need to account for the end of the year depreciation. So now we're looking at the 31st of the 12th. So we're saying 31st of the 12th, 15, P&L charge is 1410. Now I can balance this. 24,100. 24,100. Again, balance called down. 24,100. And I would advise maybe fast forwarding some of these things because it can get quite boring when you're watching them back. So maybe you can try and fast forward some of these things here. So now we're calling down, or we're bringing down our balance. 24,100. Perfect. We have to do the exact same with our land and buildings account. So we're yet to dispose of something. And we know the total value is 825. So we know that it is going to be 825,000, and we can put in our calculator on it to make sure that all added up. And again, the very end of the year is when we balance. We're going to call it down. Oh. So sorry. We're calling down our balance. Then we're going to be going into the very beginning of 16. We're going to bring down our balance 825,000. Okay, so are we done with 2016 or 2015? Yes, we are. Now, this note now is reminding me that I have to look at my disposal account and my repairs account. So I might just do my repairs account first just to get it over it, to get my few points. So I might try and use something up here. And I just have to create my T account. Nice and straightforward. Call it repairs. And perhaps think of Earl. So we have expenses and assets, revenue and liabilities. So repairs. We know it's an expense, so it's going to be going here. We can also think about it as our bank account is decreasing, so it's essentially doing a credit entry. So then when we double entry the credit side, it's going to be going to our expense when we come to repairs, or our debit side when we come to repairs. So there's two different ways to look at it. So it's coming from, it's coming from bank. It's 10,000 on the 1st of the 1st, 16. Now there's no other mention of it, so I'm just going to balance it off now. So we're going to balance it, 10,000. For next year. So the 1st of the 1st, 17. And this is the very end of the year, 31st of the 12th, 15. Perfect. So we're now done with the repairs. We don't really have to worry about that anymore. So disposal now. So we need to dispose of our land. 120,000. So this is kind of maybe one of the most not confusing, but the most work has to be done in our when we're doing disposal. So we're getting rid of 120,000. It's going to disposal. So 120,000. So it's reducing the balance of our land and buildings because we're obviously taking it away. So going to disposal of land. At the very beginning of the year, it said the 1st of 1st, 16. Perfect. So that double entry will then go to disposal of land. Again, it's double entry, so it goes on the opposite side, coming from land and buildings on the 1st of the 1st, 16. Perfect. Now, we don't want any record of our land and buildings staying in our records. So we don't want any records from this day forward of that land, because if it's there, then it's almost if we're stating we have something that we don't. So we already revalued the land, so we bought it at 80,000, but we increased its value by 40,000. Okay, so you can see that here. So what we're going to have to do is we're going to have to take out that 80,000. We're going to have to take it out of revaluation reserve. The reason we take it out of revaluation reserve is we can now realize our profits. So our 40,000 profit can now be realized. So it means that we can actually like cash out or avail of that money now. So this is going into a revenue reserve. So our revenue reserve is just a reserve of our money used for like future projects we might have. Revenue reserve. And the 1st, 16 is when it happened. So a revenue reserve on the 1st, 16, 40,000 coming from revaluation reserve. So basically, that's kind of why I think that some of these revaluation of stuff can be quite tricky when we're disposing. So we're disposing of 120,000 here. So that's the value of the the buildings, or sorry, the value of the land now. We dispose of it into our land and buildings. So that's quite straightforward enough. But what we're also saying is, okay, but we already increased the value by 40,000. So we want to get rid of that account. We want to get rid of that money. So we're not stating that we still have it, because that would kind of be like fraud. So then we have to get rid of it, and we're saying, okay, well, that's actually revenue essentially. We gained money from that. So that 40,000 going to our revenue reserve. However, how much money did we get for land? We sold for 170,000. So that money came into our bank account on the debit side. So it's going to come into our land and buildings. In our credit side, 170,000. The first of the first 16. Now I'm kind of jumping the gun, but this is P&L on the first of first 16 of 50,000. So we made a gain of 50,000. Okay. And if you go to your Earl, you can see that double entries as a revenue. So it's a profit on sale of disposal. Perfect. So we're getting there. The last thing we can't forget though is the depreciation charge for the year, 1410. So 1410, this is going to be P&L charge for the year. The very end of the year. So this now adds up to 38,200. So this is going to be, we're calling for the balance. So this is balance call forward. Again, the very end of the year. So it's going to be your opening balance for 2017. So we're bringing it down. So it's being brought down 38,200. So again, we need to balance this here now. So the bigger side is the credit side, 825,000, or the debit side, and 825,000. So that means 705,000 is our new value. Balance called down, the very end of the year, and the very beginning of the year, we're bringing down the balance. So the balance brought down 705,000. And if we look at our revaluation table, we see that that's exactly what we want it to do. So we got our disposal done and our repair done. Perfect. Now going through this quickly, we have a revaluation of 141,000. So nice and quickly. 141,000. Where is it going? It's going to a revaluation reserve. The first of the first 17. So we're double entering this into revaluation reserve, coming from land and buildings, 141,000. The first of the first 17. So we didn't have revaluation. Okay, so this is only our second revaluation. Perfect. Now, 141,000. Perfect. What do we need to remember whenever we're revaluing? We need to take away, or we need to empty out our depreciation account. For emptying out, we put on the opposite side 38,200 to a revaluation reserve. It was the first of the year. The first 17, 38,000. Coming from depreciation, first year. Perfect. So that is that. What am I forgetting? Well, I'm not forgetting it, but what are we missing? We are missing or 16,920. So we emptied out a depreciation. Now I need to add back our depreciation. Oh, sorry, I need to add back the 16,920. It's a P&L charge at the very end of the year. Now, torture-wise, we actually need to balance these again. So for balancing this, it's going to be 55,120. So just to make sure, put into your calculator. Yeah, 55,120. So we already know what the balance is going to be. It's going to be just this 1 year we had. So we're calling down the balance. Because we emptied out the account at the start of the year, our balance will obviously just be the 1 year depreciation charge. Now we're getting very close to needing more space. 846,000. 846,000. The very end of the year, 31st of the 12th, 17. It's our called down balance. Now we're bringing down the balance. The first 18, 846,000. So we'll just get some space. So the very last thing we need to do, so tick off 2017, is we have to do a revaluation and a disposal. So there's a lot to be doing in this one. So we'll have to do a revaluation first because that came first, and then secondly, we have to do a disposal first and a revaluation second. So land and buildings. What are we disposing of? We're disposing of our 246,000. So on this side, 246,000. Going again to our disposal because we're getting rid of it. On the first of the first 18. Double entry. Revaluation reserve. It's coming from land and buildings. the first of the first 18. Oh, I put on the wrong side. How did I do that? Okay, so it should be a double entry. I was looking at it wrong. Double entry would go to from the credit to the debit side. Perfect. So that's right now. I knew I was doing something wrong. So that disposal is done. How much did we receive for it? Sold for 225. So we sold for 225,000. Coming from our bank at the start of the year. So we actually made a loss of 21,000. So it's a P&L as a loss if we think of Earl. Yep, spot on. So we are done with our disposal. However, we need to do a revaluation reserve. So how much did we revalue those buildings? So we started off with 205. We went up to 246. That's an increase of 41,000. So what's going to a revenue reserve is going to be our 41,000 plus, so I'll just do this now, 41,000 plus the depreciation that was on those the building. So if we look at a table, it was 205 both years. So you can get 2% of 205,000 for 2 years, which is 8,200. So we can say plus 8,200. So I'm just going to change that to say 49,200. So it's because remember we got rid of the depreciation. Yeah, it went to revaluation reserve. So we have to take that out and add it to a revenue reserve. So 49. So the first 18 and the first 18 coming from revenue reserve, or sorry, revaluation reserve. And it is 49,200. Perfect. Almost there. So we need to incorporate the 14,300 and we need to incorporate the revaluation. So the revaluation is 115,000. So in our land and buildings, we're going to increase how much? 115,000. Revaluation reserve on the, again, it was still the first 18. So revaluation reserve, the first 18, 115. So coming from land and buildings, 115,000. Again, whenever we value, we have to empty out a disposal account. So for emptying out a disposal, and now looking at this, I realize that I've made a mistake in the disposal of buildings. So what was my mistake? I forgot to put the depreciation for the buildings into my T account. So essentially, if I'm getting rid of the extension, part of this 16,920 is in relation to the extension. So it's 246,000 at 2%. So it's 4,920. So I should have sent 4,920 into our disposal. 4,920. So remember to be focused and concentrated while doing these questions, because it's so easy to forget about these things. So 80, 29, 15, no, 16. Yeah, 16,080 P&L. So it's not as big a loss as we had. But don't forget the P&L. And the only reason I thought of that was because if we're revaluing our existing building, we actually had depreciation in here from the old building, from the extension. So it made sense that we couldn't just send that to the revaluation, because a part of it is on the extension, but we no longer have the extension. And that made me then think of, oh crap, I forgot my disposal, or to get rid of the extension. So again, we don't want any records of what we're getting rid of. So we want no records of buildings or land we're getting rid of in our accounts after the date. So that's why I have to get rid of disposal. So now I can empty the account. So 12,000 will go to revaluation reserve. $12,000. Perfect. Now, we should be done except for our P&L charge for this year. P&L charge for this year, 1430. So 14,300 going to P&L. Again, always the very end of the year we charge this. Perfect. So to make sure that everything's right, we can balance it. Oh, I'm probably missing something there. Yeah. I'll need a bigger space here. So the total is $31,220. So it's going to be the charge is going to be our BAL call down for the very end of the year. My hands are hurting just from writing dates more than anything. So what's brought down is 14,300. So that's going into the future. That's how much appreciation we have. Now we have to balance our billings account. So the total is 846 and 115, 961,000. So less 246 is 715, and that's what we said we revalued it to. So that's our balance called down for the first, for the end of the year. Then our opening balance for 2019, balance brought down 715,000. Disposals already balanced. Both disposals are balanced. Now we need to balance our revenue reserve. So it's going to be 89,200 for revenue reserve. So this is a realized profit that's going to be added to our finance by section. Balance called down at the very end of the year. And the beginning for next year, balance brought down 89,200. Don't forget to fill in everywhere. And then revaluation reserve. So there's a lot here that we need to add up. So 12,000, 15,000, 38,200, 141,000, 48 and 140. So 494,200. So that's how much we kind of revalued everything by, not including what we've gotten rid of. But when we do include what we got rid of, we then get minus 405. So essentially our balance is 405,000. And that's essentially how much we revalued the initial building when you include the depreciation as well. So obviously we get 315,000 there, but if we also include its how many years of depreciation it had, that would give you 405,000. Because everything else, because the only thing that's left in the revaluation reserve, because we sent some things to revenue reserve, so the only thing that's actually left is our first building. So we got rid of our land, we got rid of our extension, so we only have the first building that we had. So again, I got my dates wrong because I'm not paying as much attention as I should be. 31st of the 12th to 18, 1st of the 1st 19. Is everything looking good? Repairs, revaluation is balanced. Depreciation building balanced. Disposal, revenue reserve. It's all looking good. So that is that. So we're just under the hour mark. However, it should basically take you 26 minutes to do that question. Now, I've obviously been explaining and taking it really slowly, and it's a lot harder to write with the way I'm writing than it is on a pen and paper. So you should be able to kind of go through it quite quickly in an exam. Now, we're not even finished though is the issue. And that's why sometimes doing a question one can actually makes more sense than doing the 60 markers if they're quite long. And that is, we need to show the relevant extract from the balance sheet as at 31st of 12, 2018. So what does the balance sheet look like based on what we have? So I might just do it here underneath the table, probably makes more sense. So we're going to have 3 columns. Just draw them as getting prepared. So we're dealing in euros. Now, so we're going to have our fixed assets. So this is where our land and buildings are going to be. And then we're going to have our capital and reserve down here. So part of our fixed assets are land and buildings. So at the moment, we now have 715,000. So if you go over to our table, so we can see our land and buildings. So what we brought down for the beginning of 2019 is 715. Or depreciation is 14.3. So we can just use those figures. So 14,300, 715, and so that's 700. So 700, 700. In our capital and reserve, we'll then have revaluation reserve. And revenue reserve. Our revaluation reserve was 405. Revenue 89.2. 405. So 405 and 89,200. And that is all of the practical element of the question. I should actually put in maybe here, just so you know, balance sheet extract as on the end the end of 2018. So balance sheet extract as on the 31st 12 2018. So then just on the theory, we're asked to distinguish between capital and revenue expenditure. So even just from junior cert business, capital expenditure is all based on long-term spending. So it's our purchases of generally our fixed assets that are greater than 1 year, buildings, vehicles, laptops, technology. So that would be capital. It's almost like investing it for the future to some degree, or you're spending it for the future. Whereas revenue expenditure is all to do with your short term. It's kind of like what you need to spend now to gain revenue. So things like your light and heat, maybe your rent, that'll all be less than 1 year. And it's kind of like you need it now. So that's to distinguish capital and revenue. So if we're talking now about a revenue reserve, so what a revenue reserve is its profit that is kept within the business to be used for future projects or activities. So it's not given out as dividends to the shareholders. Now, in terms of a revaluation reserve, we just because the value of our buildings or our land increases, that doesn't mean that we automatically see the profits come into our bank account the next day. It's unrealized profit. So the value goes up, but unless we sell it, it doesn't really matter how much the value of our land and buildings is. But we do have to show it as an accounting point of view. However, when we do sell, then we realize the profit, or we actually have made that profit then off the value that we sold it for. So that's where we get that. So I'll just show you, let's say, the marking scheme for that, so that you can have a rough idea of the way in which you'd have to phrase all these things. So we can see that capital expenditure, as we said, refers to expenditure on items where benefit is derived, is expected to last a long time. So we're kind of spending for the future. So we're going to benefit for longer than a year. So our land, we should have more than a year. Buildings, purchase of machinery. So the big expensive stuff. However, revenue expenditure refers to expenditure where the benefits derived is only temporary. So our annual rates, which is a rent, don't last that long. Let's say light and heat wouldn't last that long. Repairs. So then looking at our revenue reserve, as we said, it's undistributed profits. So it's not paid to the owners in dividends. It's retained by the business. So why would a business retain profits? To invest it for future projects. Then we talk about revaluation reserve. It comes from land and buildings as they increase in value, but we obviously can't make the profits unless they're sold. So it isn't transferred to the revenue reserve until the fixed asset is sold. That's called realizing your profit. And up until the sale of the fixed asset, this profit cannot be distributed to the owners. So we can't realize it until it's sold. Okay, thanks very much for watching. I hope that made a bit of sense and will help you with your accounting exam.